Good morning. It's let's see, March 31st, 11 a.m. here in Utah. Got a nice day. We're just doing some weekly get-together classes here just to kind of let things settle in by repeating them over and over. It takes a little while to grasp all the things when it comes to options. Once you do that, though, they do become pretty routine. It just takes a little while, so don't get scared off. Let's get started here. Let's see, where are we? All right. Today's kind of conversation here, what I'm going through is using bullput spreads to raise cash. If you're brand new to trading, that can seem like an awful lot to hear, but we'll just go through these and make it routine as we can. All right. Logan's Grove. To get there, it's logansgrove.com. If you're watching this and later on, here's the disclaimer. It's just everything we do is for training and educational purposes. Yes, we do get into trading real money and real positions and things, but we never want anybody to risk anything more than they're willing to lose. Working capital is risk capital. If you lose it, your life doesn't change. But here, if you follow the rules, you'll be very, very well protected. All right, learning option strategies. I have some reminders here and a little bit of notes before we go over and look at the Thinkorswim trading platform. Process for people that are super brand new, just to get you up and running with Thinkorswim. That's the trading platform with Charles Schwab. Number two, get you familiar with the terminology associated with options. Just to hear them can be mind-bending, but be patient. We want to learn one component at a time. Look at this as a kind of a watch that you're putting together, an analog watch, all the little cogs and gears that come together to make a really smooth strategy. We want to move you into trading and managing your positions with our group so that we go through the demo accounts, and we're working here in classes like this, just getting you up and running. And then you can merge into the group that's actually trading demo accounts or live money. And then you'll understand and be able to follow along a lot easier with what folks are doing. Number five, to advance you to a level you are comfortable and confident with yourself. In other words, do you have faith that you'll make the right decisions when you need to? And that makes a world of difference. Number six here, get you profitable. And that's consistently being able to pull money out of the market without undue stress on your account. Notes. Number one, if you're new to trading or to options, don't allow the terminology to deter you. There's a lot of potential and upside to this. It can be life-changing, so it may seem overwhelming, but allow it to soak in and it will. The strategy that we use is put into action Monday morning and resolved or adjusted on Friday. Sometimes we make adjustments on Wednesday, but this is not day trading. If you're someone who does not want to sit in front of your computer all the time and click buttons and trade, this is an excellent strategy, and you are not sacrificing results to do this differently. This strategy allows you to go about your daily life, your job, or your schooling. You can be totally involved with raising family. You can be in college. You can be in your career. But this does allow you to step into the markets and be really involved without it taking up a lot of your time. The strategy is to generate income or growth depending on your goals. You may be someone who's wanting to supplement retirement income. You may be someone who wants to grow a retirement account before you draw on it, or you may be someone who wants to leave a legacy to kids or grandkids by growing an account. And this strategy is designed to protect your working capital at all costs. Many traders that get into this day trading scenario blow up accounts and lose things and never come back. Here we are here to perform high proficient trading, high performance trading, and manage positions. It's more managing the outcome versus just trading. Okay, this is from Debbie Novak. I'm going to break it down to little smaller pieces so that I can help explain it as we get going. The house tenant weekly strategy. The whole idea here really is to raise money. Step one here, earn enough cash to build up enough to buy a house. And when you have enough money that you've raised by trading in the market, then you purchase the house. And then each week after that, you rent out the house for income. And we say weekly instead of monthly because we're doing weekly options. They open on Friday, Monday, and expire on Friday. So that's our goal. Raise money, buy a house, rent the house out, and collect rent weekly. Now, there is the option here or the strategy where you buy the house outright. But in our first starting, we want to look at, can you raise money to buy the house? Component number one, using bull put spreads, AKA they're also called a vertical, to raise money to purchase a house. A bull put spread is a strategy that option traders use to generate premiums weekly, and when they get enough premiums, they buy the house. Step two here, the house is actually called a leap. What we're really looking for is a leap, and a leap is an option that's longer than 1 year. We're typically try for around 2 years. The idea behind here is once you get the leap paid for, your house, it's free to you and you collect money weekly. And at some point between now and when it expires in 2 years, if you get some really nice price appreciation, then you execute your option and you buy the leap out at the price you bought it at, and you can make some really nice appreciation values. And then once you own the leap and you purchase the house this week, you write covered calls, and that's how we rent out the house. And these may sound a little odd at first, but we're going to go over and look at the markets and show you how they are in the strategies world. Okay, let's go over to, let me switch really quickly here. Bull put spreads, it's our topic. And if a person wants to do a screenshot or whatever here, this is a paragraph or two that I pulled away from Investopedia. No reason to rewrite something that's already written very, very well. What is a bull put spread? I'll read through it and then it'll make more sense as time goes by. A bull put spread involves selling one put option while buying another at a lower strike price, both with the same expiration date. So this strategy you would put on Monday morning and it would expire Friday when the market closed. This strategy allows traders to benefit from a stock's upward movement or simply remaining stable while limiting the risk of losses. The two put options form a range consisting of a higher strike price and a low strike price. The investor, the trader, receives a net credit from the difference between the two premiums. Now, right now, as we speak, the market is quite fickle. And so a bull put spread might not be what you'd want to do if you've had the experience, because the markets are kind of working their way lower. And so we don't want to be putting bull put spreads below prices. We prefer the market to be working up or stable, but we're still going to work on the bull put spread here. Key takeaways. A bull put spread is an option strategy used when an investor expects a moderate rise in the underlying asset price. Our asset that we're trading is the TNA. It's an exchange traded fund. It's the mirrors the Russell 2000. You could do it on Apple. You could do it on Google. You could do it on Tesla. We use the TNA because it's already diversified and we want control of our risk. And it's just a mid-size index, so to speak. An investor executes a bull put spread by buying a put option on a security and then selling another for the same date but a higher strike price. The maximum loss is the difference between the two strike prices and the net credit received. Strike price is just the price. And so in this contract between an option buyer and an option seller, they have a price that can cause the contract to be optioned, executed. The maximum profit is the difference between the two premium costs of the two put options. This only occurs if the strike price closes above the higher strike price at expiration. So we put on a bull put spread, and if prices stay above our bull put spread, then the option expires worthless on Friday and the premium is kept. Now, let's go over to Thinkorswim. Get some of these windows out of the way. Make sure I'm in my demo account. If you're new to Thinkorswim, we also get together and just talk about Thinkorswim. Here we are just looking at the monitor tab up here in the top left. I have nothing open in this demo account. I look at the last two numbers, 55. On the left here is my cash balance and everything that's working on. I only have one symbol that I'm watching, TNA. When people are new, I don't want them accidentally having too many symbols there and clicking the wrong one. This just really cuts down on mistakes. Then I have a calculator down here because we do use calculators. Next thing, I'm going to run over to the tab chart here. And I'm going to look at this chart. I have a daily of the TNA. You'll notice my number 2 here is yellow. The symbol link in my chart is a 2 yellow. So whenever I click on a symbol, the chart will match it. And that's what we want to do. So if I did have a bunch of symbols, the chart would change to the symbol that I'm clicking on. Okay. You can see here I have a mark that's $27.20. I have an alert there, just that it will email me. It goes to my phone or my computer to let me know prices have hit a level that I'm interested in working at. So that's why I don't have to be in front of the computer. Okay, I'm going to go over here and look at the chart. With a bull put spread, we are buying and selling a option contract at the same time. Different strike prices, but it expires on this coming Friday. So I'm going to take this thing down to let's see here if I got a 4-hour chart, and I'm going to slide over a little bit more. All right. So if I want to be below prices, looks like we're getting an apex reversal candle, and I want to be below, I would write a bull put option here below prices. And let me write down some numbers on my scratch pad here. If the market looks like it's turning and heading up, it's awful early, but I would write below, and let's just look at 27 and 26, prices 27 and 26. I am going to real quickly here go into my settings, and I'm going to turn off these high-low bubbles because that's getting in the way of seeing things. And I am going to draw. I'm going to put a price right down here at 27. I'm going to pretty close to 27. And I'm going to look at this one here. I'm going to draw one at 26. We'll have to adjust these as you're just allowing us to think a little bit. Okay. Let me get rid of this one. And I'm going to get rid of this one here. So if I write a bull put spread and prices stay above my lines, then I keep the profit from the premium. So I'm going to write a vertical, it's called, where I would buy a prices hit here, and if prices continue to go through, I would sell those shares here. So this is my protection, and this is my entry. So what I do is I go back to my trade screen here, and I'm going to shrink this up. When you go to the options trade screen here, you see the option chain, and Friday is April 4th. So we want to be in the most recent week. We have 4 days left in the week. It means 100. One contract controls 100 shares. The strike price is just more, it's the price of the agreement of the contract. So if I'm looking at 27 and 26 in here, we're on the put side. So if I was going to write a bull put spread, I would come in here and I would get 26, and I'm just going to right click and I'm going to sell. Window pops up, another window pops up, and it takes a little while to get used to all these, especially if you move your mouse too quickly. And I'm going to go up and do vertical. Vertical just means that I have two prices stacked on top of each other. A single would be one price. So I'm going to do a vertical. I'm going to close up my calculator here a little bit, and I'm going to read where it says in the far left here, vertical. The top order at price 26 is, I got to adjust my prices here, is a sell order for a -1. My buy, with prices continue to go through, is a +1, and that's my protection. Now, I had said 27 and 26, it popped up 26, 25 here. What this is saying is if I run this order through, I will be paid, if I get the price, 15 cents. And 15 cents times 100, because it's one contract, would be $15. Okay. Now, if I want to adjust these prices to see if I can get a better premium, let's go up to 26 and a half. Now, at 26, I was one strike price different, which means I could lose 1 point, and 1 point is worth $100. So the most I would lose on that trade at 26 by 25 would be $100 plus fees and commissions and all those things. Here I am what's called 1.5 wide. The difference between 25 and 26.5 is 1.5 times 100. So I'm risking $150 to make 26 cents, 26 times 100, $26. So if you're good at reading prices and you understand the way the markets are moving, and on odd days where you think that there's too much uncertainty, you don't do anything, you can get some really nice return on your time. Now let's take this up. Now I'm going to go to 27. You can see that I'm now able to make 42 cents per contract times $100, $42. But here, difference between 25 and 27 is two full prices. So that's 2 times 100. So I'm risking $200 to make $43. I can come to 25, and I'm going to raise it up to the 26 where we were. So it drops down to 24. Our goal is to try to always make at least 25 cents. That pays for commissions and fees and allows us to slowly chip away at needing to buy or wanting to buy a leap. So we're raising money here to buy a leap. So at 26 cents at the moment, it's a limit order and it's good to cancel. This is 1 unit. So let me click confirm and send. And over here, you don't have to do anything fast. If you're trading the futures on a 1-minute chart or the currencies or things, you typically don't have time to think. You got to just keep working and doing what you need to do. The description here is I am selling one vertical because there's two prices, one on top of the other. TNA, that's the Russell 2000 Exchange Traded Fund, 100, meaning one contract covers 100 shares, and it's weekly, expires on Friday for April 25, and the two prices are 27 and 26. They are puts. I'm buying one and selling the other at 25 cents. Now I could get a little bit more at the moment, and it's to open the positions. My break-even price is the lower price plus the premium I'm getting. So the maximum profit would be $25, and I scoot down to here, $25 minus $1.30 in fees. I would make $23.70. My maximum loss, if I take the one strike price and I subtract off my profit that I'm paid for the contract, my maximum loss is $75. Not bad, making 25 and risking 75. So I'm going to run that one through. And if I'm quick enough, you can see it working over here. It is, and there it went through. You get these little windows that pop up. Now I'm going to go to field order. So we're going to read this here in the field order section. March 31st at 11:21:42, Utah time, Mountain time, vertical. I sold the 27 put. I at the same time bought the 26 put, and I got 62 cents for selling the 27. I paid 36 cents for buying the 26, giving me a net of 26 cents. So in these verticals, there's two transactions. I am selling the top number, and then I'm buying the bottom number. In the world of options, the seller is collecting insurance premium. In case prices drop too far, somebody else is saying, if prices drop to 27, I want to guarantee that I can sell them at 27. I'm willing to buy them at 27, but they're going to pay me 26 cents for me to take on their risk. Well, I've added risk for myself by buying instead of selling the 26, which says if prices hit 26 before Friday or on Friday, I have the right to go ahead and sell my 27s at 26. That's how I guarantee that I'm only going to lose $100 minus the 26 cents, so about $75. And that's the neat thing about bull put spreads. If prices do land in between these and doesn't hit the 26, the 27 could be executed. In other words, the option buyer, because I'm the seller, will say, you got to buy my 100 shares at 27. So 27 times 100 would be $2,700 that I need. It's called a cash covered. So I need to be able to have enough money to cover that $2,700 if prices hit there. And they may not get to 26. They could sit at 26 and a half, and I would be holding those shares. Now, certainly I could sell it at 26 and a half at the market and then get a smaller loss, but I still need to make sure that I can afford the 27 price if shares get to me. And if I'm going to come over here and say, well, gee, I want to do more in quantity, I need to make sure that I have enough to cover those. So they're called cash secured. You've got the money to be able to cover the deal when you make the contract. If you don't have the cash to do it, they're naked, and you have to have a margin account, and not something we do because we stay out of risk. All right, when I come down to here to my TNA, these are my working orders here. The underlying instrument is the 100 weekly for April 25, 27 put. And then there's a 26 put, and it's a Direxion daily small cap bull, 3 times leverage of an exchange traded fund. So that would sit. And if on Friday prices stay above 27, I keep my 26 cents. And that's how you slowly raise money. Now let's go back to the trade here. In our little PowerPoint, we were talking about we are raising money to buy a house. So we're going to look at this option chain here, and we're going to go all the way down to the bottom. You can see these are all weeklies, and then they start changing day-wise. So once we get over 100 days, they're called leaps, or just longer-term options. I'm going to go to 15 January of 2027. I have 655 days till the end there. And I'm going to open it up, and I'm going to scroll down and look at prices. All right. When you buy on the left-hand side here. If we were going to buy, the only things available right now are the 25 for, they're asking $11 for the 25, $10.95 at the moment. That is $11. We'll just do 11 for easy math, times 100. That's $1,100 to buy the leap. So we need to raise enough money to buy that leap by writing bull put spreads. And then how long does it take on a weekly basis to raise money to buy the bull put spread? We do this to teach people how to trade options. We could go right out and buy the leap and then start writing calls against it to generate money. But this is where we're going to start, and then we'll build from there. So I keep that in mind. Their prices are bouncing around quite a bit because the market's doing a lot of interesting things with the world that we live in. So now let's go back and close this one up. We know what we're wanting to do. We're wanting to buy. Let's go back to our options. So the one I just did earned me $26. And it was $1,100 to buy a leap. We're making $26 here. I'm going to divide that by 26. That would, and I wished I could make these bigger, but I can't. It would take me 42 weeks if I earned 26 cents a week doing just one put and one call, 42 weeks to pay for my leap. Then I have over a year, because it goes clear out to 27. It's free and cleared, and my house is paid for, and then I can collect rent. And that's the concept of acquiring an asset and then generating income off of it. Now, we could do this much faster if we have the cash to do it and we decided to do 2 bull put spreads. We could get there much, much quicker. We need to make sure that we have the ability to cover them. So let's move my calculator back. Let's go to the trade stream. And let's go back and just look at another bull put spread. Want to make sure I'm on 4 April 25. And I'm going to click on the 26. And I'm going to say sell. There's another window. Remember, it's a vertical because they're sitting on top of each other. Okay, 26 by 25. Let's take this thing up to 27 by 26. So about the same price. And if I end up owning those shares, it's $2,700. 100 times 27. So if I come over here and I say, oopsie daisy, I want to do, just for easy math, I'm going to do 10 of these. Okay. So 2,700. So I would be looking at $27,000 if prices hit the 27 and I had to buy them. I need to make sure that I can afford the trade. Now, over here, my option buying power is 100,000. We're not going to use more than 25%. So 27,000 is 2,000 over my 25%, and I don't want to throw it all into one. So what I'll do is I will back this off to 9. And I'm going to go over here to close this up. And I'm going to go to confirm and delete here real quick. I'm just going to look at my maximum credit instead of the $26 at 9 is 213. It would not take me very long if I have the size of account to end up buying that leap pretty quickly. So I'm just looking at that. And I'm going to go to my calculator again. I'm going to delete this one, go back to here. I'm going to multiply that times 9. So that's 24,300. So I'm actually below my 25% commitment. That's the maximum I could do for the week. The only order. If I don't want to put that much on, I don't have to. But that would, and we'll go right back to it. Put it on again. Sell. Vertical. And delete it. It's green, so my fingers slip. And you got to be careful when you're moving your mouse around on these screens because they kind of move and do things. So red means I'm selling, green means I'm buying. And once you get used to that, that really helps. Again, you read vertical. I'm selling the top number. I'm buying the lower number. It's a TNA. I'm going to take this thing and I am going to take it down to 9. 27 by 26.5. That's only 10 cents, 18 cents. That's not bad. If I could actually get my quarter and only risk $50, that would be good. I'm going to take this to 26. So now I'm up to 27. If I want that 27 price and not accidentally the 17, I have to put the lock here. That's the price I want. It's a limit order. I want 28. Good to cancel. So I'm going to push confirm and send. And again, we do not have to be in a hurry. And inside the demo account, you can open these up. You can delete them. You can put them on. You can work your way out. All right. My break-even price, since I'm being paid a net, would be $26.72. My maximum profit is $252. If by Friday prices stay above 27, I keep the $252. I do pay $11 in commissions and fees, so I would end up with $240. And my maximum loss is 648, not including dividends or whatever. So really, that's not a bad ratio, making 240, risking 648. So I would push this in. And it got there before, and I got 28. Now I can go back to my monitor and I can go to filled orders. So we saw the first one here where I made 26 cents. And then here I made 28 cents. So that's what I have going. All right. If I take the $11, that was the cost of the premium of the leap, multiply that times 100 because the multiplier in options is 100. Each contract controls 100. $1,100. And if I can divide the $240 that I just earned, it'll take me 4.5 weeks to own a leap. And then when I own that leap, I get to own that leap for almost 2 years and collect money free every week on it. So that's the concept behind building a house and then renting it out. Now, the other version of this is we go to the market and we buy shares, or we go over and we buy our leap. So let's go down, close this up. All the way down at the bottom again, I have 655 days till expiration on this leap. Price is 27, 29. Let's see. Let's do the 29 here at $9.50. They're bouncing around a lot because there's a lot of uncertainty going on in the world at the moment. So if I buy that at $9.40 or $940, I own that leap, and if prices go up from 29 until they close in 655 days, I can exercise it. So if prices are at 40, I get to say I'll buy it at 29, and then I go ahead and take my $11 per share profit and then close out my trade again. So that's the idea behind it. So if I just click right here, now I want to buy a single. It's green. I'm buying a single. It's a +1. I only want to do one leap at a time. 15 January of 2027. Strike price is 29. It's a call. I will be paying $9.20. Now we want to pay less. We may not get it in a demo, but when you're selling, you want to be paid the most, and when you're buying, you want to pay the least. So limit order, and it's good to cancel. I'm going to push confirm. Buying one TNA, 100, 15 January 2729 call at $8.95 times 100. So limit order, good to cancel. To open my position, it'll cost me $895. So I'm going to go ahead and send that over. So this is me buying the house. And we can see that the mark is current price is $8.90. And my price is $8.95. So I got $8.70. I even got a better price. All right. And then I come down to here and I see my 100, 15 January 2729 call. I own one of those. I paid $8.70 for it. At the moment, it's $8.92. So there's a big spread between them. So now that I own this, the other side of the bull put spread is a covered call. Call says, I am willing to sell this at some point in the future and take the money early, or I can wait and exercise it. In our strategy, we are selling the call weekly so that we can collect rent. We don't ever want to have them take our apartment building or our house from us. So when we write that call, we need to make sure we are away from prices. So let's look at this call, and I'm going to go to trade. Make sure I close this up and don't accidentally trade something I'm not wanting to do. On Fridays for April 25. Now, over here on the call side, I want to be above prices, and prices right now are at, let's say, 29. We want to be typically 10% above that because the TNA doesn't normally travel 10% in a week, though all rules have been off recently. So we go down and we look at what it's going to, what we're going to get paid. And we're looking for a minimum of 25 cents. I can see 27 here at 32. So 29, 30, 31, 32. I'm more than 10% out. So it's a relatively safe trade. So I would write here, and I'm going to sell because when we sell, we get paid the premium. Slide over, and I'm going to go up to single. Remember, the bull put spreads a vertical. But here we don't have to do a vertical because we own the leap. Single, sell, -1. I have one leap, so I only want to write one call. If I had 5 leaps, I would do 5 calls. TNA, I know this is redundant, but it keeps you out of trouble. For April 25, strike price is 32, meaning if prices hit 32, the person that buys this contract from me can say, sell me your leap. I want the most I can get. It's a limit. It's good to cancel. I come up here, read this. So if prices stay underneath 32.27, the premium that I got on, that's my break even, I will keep my $26.35. So I'm going to put that in. And it's working. So we use bull put spreads to generate cash so that we can buy a house. And then we rent that house out by writing calls above it. So our calls are above, our puts are below. We want to acquire down here. We're willing to get rid of them up here. And we repeat it. Now, we were doing bull put spreads because we wanted to risk how much we could lose by there being one strike price in between, namely 26 and 27. If you have the cash, you could do cash secured puts so that if prices hit them, you buy the shares outright. You don't have to do the other component. But we want to control our risk. We are only raising money to buy a house so that we can rent it out. And then you just repeat and repeat the process. Again, over here in Thinkorswim, it's really important just to practice these things. Don't worry about getting into trouble. You can get out of anything you want. Now, I have my 32 call that I put on, all right, to offset my one leap. This is a call against my leap. And then I have my bull put spread, my 26 put, and my 27. Those are 10 and 10. And then I don't have any shares. If shares get put to me or I buy shares, this number will show here. So that's everything that we just did. And we can see the credit prices are up here. Credits are in red, debits are in green. And it's really straightforward. It's just critical that you read a chart and critical that you don't over tax your account base. So Debbie has been teaching us a wonderful strategy. It's the opposite of what a lot of people do in the market. Remember, we are taking the role of the insurance agent. We're willing to take your risk if you pay us a premium. And we watch the charts and we do make decisions based on the fact that we don't think you're a reckless, dangerous driver, and we'll get to Friday without having to settle a claim. If by Friday or in between prices get close to our strike price, or we may have to fulfill our part of the contract, we can always roll, adjust, or move our positions. We're not just necessarily stuck with it. That's the fun thing with options. It is mostly just the word options. We have all kinds of options, and we get to make decisions that other people don't. If you buy the option and you're waiting for prices to hit the strike price before you can make a decision, you're at the mercy of time. Here we want time in our favor, and we want each day to disappear, where the buyer is running out of time, where we want to let time run out. Any questions, make sure you holler out here. I'll be doing different versions of these through the week because I just think it takes a while to get in the swing of it. but once you're up and running, it really makes a difference. All right, I got about 45 minutes. That's enough for recording. And then we'll see you Wednesday and Thursday if you can make it. Not Thursday, I'm sorry. I am traveling on Thursday, but you can pop into the room and if you want and talk amongst yourselves and work on the trades. I will see you this evening at 6 Mountain in the trading room. All right, appreciate the company.
Thank you, Rex.
Oh, you bet. If Danny, you give me any suggestions on how I can do it better, let me know. I'm trying to slow her down so I can keep my thoughts straight.
Okay, well, I didn't know if you wanted us asking any questions during that time or if you just, I didn't want to confuse the new ones that are coming in either.
So yeah, I'm practicing, and then what I'll do if these recordings are okay, I'll send them the recordings so they can watch them because they're not all have the same schedule. But um,
Okay, yeah, I didn't know if you wanted us asking questions during the recording or not.
so nope, that's fine.
Okay, I do have one.
What do you have?
Um, I was just those bull put spreads. Can you do the same thing with a call? Like where it looks like the price is kind of going down right now. Can you do that same thing with a call?
Yeah. So when we're below, it's a bull put spread. When we're above, it's a bear call spread.
Oh, they got a name for a bear. Okay.
So if you put the bull put spread and the bear call spread together, you have the iron condor.
Oh, that's what they call an iron. Oh, okay. But you can do them separate too.
You can do them separately.
Ah,
Now, the reason Debbie says she doesn't like to do the bear call spreads is we're under the assumption that we want the markets to go up. So
oh,
we don't
that's
want to
yeah.
get ourselves, but in this type of market, if you can get some good premium and you're away from prices, you could do the bear call spreads.
Okay.
Yeah. So bull put spreads underneath, bear call spreads above. If you put them both on at the same time, it's an iron condor.
It's an iron condor.
And if they're too close to each other, it's called a butterfly because their little wings get broken.
Oh, okay. Well, oh, then the next question I have is how do when you just if you decide to do that, whether it's a bull puts or a bear call, um, do you want to figure like you do when you're covering your leap covering your leaps and your shares? Do you want to go 10%? Is that where you want to kind of figure your putting
Yeah.
placing your spreads?
So we want to be above where the prices may move
Right,
because, again, we want it to expire worthless. We don't want to have to do something.
right.
Take this back up to the daily. Now, there is resistance here at 33. I don't know that if there's even going to be a price there, and there may not be any premium.
Right.
So I'm going to go over to the trade screen. 6.33, 21 cents. So let's just as an example, I'm going to sell a vertical. Now I'm above, right? So if prices hit 32.5, um, I lose my shares, and then at 33, I buy them back. I'm only getting 4 cents at the moment.
4 cents. Okay.
Yeah. So let's take this thing down to 32. It's a dime. I don't want to get too close to those prices. Let's go to 31 and a half. I get 20 cents, but I'm risking $150. Let's go to 32 and a half. So here I'm risking $100.16. So we know our minimum is 12 cents.
Right.
So if I write a call, that means I'm willing to have you take 100 shares from me. You'll call them from me. I'll have to sell them to you at 31.5. And then if prices keep going up, I buy them back at to close the position at 32. That's where I lose my $100.
Okay.
So now if you had shares, then you don't need to do the bear call spread. You would just do the call. Because here you won't lose your leap because you're secured
Oh,
it with the other. Yeah.
okay.
So you just got to be careful. That's why I think people in this morning's room were just saying they're kind of sitting back and watching because there's a lot of news this week. Debbie's traveling. I'll be traveling later on and won't be able to manage things.
Yeah.
Yep.
Well, that's, that I thought I didn't know if I was going to be here or not, but I covered mine last week, but my penny hasn't, they haven't picked it up yet.
So yeah,
So I
so
still,
if it picks it up by Friday, I mean by Wednesday, you can redo it.
yeah,
And if it's
yeah,
down to 4 cents, you can buy it back if the spread's good and put it back on again. And then only
okay,
hold it from Wednesday to Friday.
okay. And then pick up another quarter or whatever.
Right. So you're
Yeah,
you're getting your doubling your premium in the same
yeah,
time.
yeah.
Yeah,
Okay.
it takes a while to get the swing of it, but once you get it down, and
Yeah,
so I know a bull put spread and a bear call spread equal
we'll
an
call
iron condor.
on the
If they're
phone.
too close in price, it's a butterfly.
Okay,
So
okay.
So we know a lot right there. And then the fact
Yeah,
that we do this here is it's just the bear call spread. So it's a vertical because one
vertical
price is on top of each other. So vertical can be a bull put spread or a bear call spread.
or a bear call spread, either one. Okay.
Yep.
Okay, that helps a bunch. Thank you. Hmm.
It's just like staying in at recess going, I can't figure this out.
I know, man. Yeah, yeah, no,
But
this
it's
is,
very profitable.
I can't remember
yeah,
nothing, Rex.
yeah, yeah, no, this helps. I just uh, trying to ask Debbie all them when she's got all them others in there. But this, this really helps a lot if you don't mind me asking questions during
No,
your talk.
nope, don't mind at all.
Okay,
It helps me explain it better without rumbling around and not knowing what I'm saying, and I'll get
yeah,
better at it, and it'll help
yeah.
everybody.
Well, I sure appreciate this time.
So you bet. All right. Well, I'm gonna
Okay,
skedaddle, and I'll see you guys if you can make it this evening.
okay. Thanks again.
You bet. Bye bye. See you, Larry.